Here's something nobody saw coming. If you put $10,000 into the S&P 500 on January 1st of this year, the index everybody tells you to buy, the one packed with Nvidia and Apple and Microsoft, today you'd have about $11,125. But if you put that exact same $10,000 into SCHD, the boring dividend fund your dad probably owns, today you'd have $11,950. That's $800 more in just 5 months. From the fund everyone said was dead. So is the boring fund finally winning? Or is this just a head fake? Stick with me, because the real answer surprised me. And by the end of this video, you'll know whether SCHD belongs in your portfolio right now, or whether you'd be buying right at the top. This isn't a small story. This is the biggest reversal in dividend investing in over a decade. For 3 straight years, 2023, 2024, 2025, SCHD was a punchline. While the S&P 500 was up 20+% year after year, riding the AI boom, SCHD was crawling along in low single digits. One major analyst called it, quote, exactly where you did not want to be. Then 2026 happened. New Fed chair, inflation back, oil shock, tariffs, and suddenly the same boring fund that everybody dunked on is beating the market by 8 percentage points. So what changed? And more importantly, does it last? Let's start with the receipts. Year to date in 2026, SCHD is up about 19.5%. Total return, dividends reinvested. The S&P 500 through VOO is up about 11.25% over the same window. That's an 8-point lead in 5 months. SCHD is trading around $32.24, right near its all-time high. It manages about $95 billion in assets. It charges you 6 basis points, 0.06%, in fees, and it pays you a dividend yield right around 3.3% while you wait. That's a real, measurable win. And if your finance YouTube feed has been screaming about it for the last 2 months, they're not making it up. But here's where most videos stop. And here's where I want to do something different. Because if I just told you that story, I'd be lying to you by omission. Stretch the chart out to 3 years. SCHD is up about 50%. The S&P 500? Up about 88%. Stretch it to 5 years. SCHD is up roughly 51%. The S&P 500 up about 93%. And here's the punchline that almost nobody is showing you. Over the trailing 12 months, 1 full year, SCHD is up 28.9%. VOO is up 29.8%. They are basically tied, which means SCHD didn't actually beat the S&P 500 in 2026. It survived something the S&P 500 didn't. Let me show you what. Rewind to early 2026. The market was rattled. New administration, new tariff announcements, new Fed chair on the way, a Middle East conflict pushing oil prices higher, and inflation that suddenly wasn't dead anymore. By late March, the S&P 500 was actually down about 5% on the year. SCHD, up 10%. That's a 15-point swing in 3 months. Not because SCHD was on fire, because the S&P 500 had cracked, and SCHD didn't. Then the market recovered. The S&P 500 has since rocketed to all-time highs, closing above 7,500 for the first time in history. But SCHD never gave back its lead. So here's the honest version of what happened in 2026. SCHD didn't beat tech. Tech got punched in the face. SCHD didn't. And when both got back up, SCHD had built a lead that the rally hasn't erased yet. That's a really important distinction. Because if you think SCHD is going to keep beating the S&P 500 by 8 points a year, you're going to be disappointed. But if you understand that SCHD is the fund that doesn't crack when the market cracks, that's actually more valuable than you might think, especially right now, with the S&P 500 at all-time highs. Now here's the part where most explanations of SCHD get it wrong. They'll tell you SCHD beat the market because it doesn't own tech. That's not actually true. Let me show you what SCHD actually holds. SCHD's largest sector is actually technology. Almost 20%. Its 2 biggest holdings are Qualcomm and Texas Instruments, both chip companies, both tech. So what's the difference? The difference is what kind of tech. The S&P 500's tech is the Magnificent 7, Nvidia, Apple, Microsoft, Google, Meta, Amazon, Tesla. Story stocks, AI bets, high valuations, no dividends or tiny ones. SCHD's tech is the boring stuff. Chip makers that have been paying dividends for decades. Companies that print cash today, not companies promising to print cash in 2030. So when the AI trade is on fire, SCHD loses badly, which is what happened from 2023 through 2025. But when investors start asking, wait, are we paying too much for AI? And that's exactly what happened in early 2026, money rotates out of the Magnificent Seven and into the kind of stuff SCHD owns. Energy, staples, healthcare, boring profitable chip makers. That's what the rotation actually is. And the new Fed chair, Kevin Warsh, sworn in May 22nd, just made that rotation stickier. Because Warsh is signaling he's in no hurry to cut interest rates, which means the AI megacaps don't get the easy money boost they were counting on. A recent MarketWatch headline summed it up. Kevin Warsh's Fed isn't cutting interest rates anytime soon, but a hike isn't yet on the table either. In English, higher for longer rates, which is rocket fuel for dividend stocks and gravity for high multiple growth stocks. Okay, here's where I have to be honest with you again, because everything I just told you is the bull case. There's a real bear case too. Number 1. If the Fed reverses course and starts cutting rates aggressively to support a slowing economy, the AI megacaps could come roaring back. Number 2. SCHD's dividend stocks are not immune to recessions. Energy and chips both get hit hard when the economy slows. Number 3. The dividend trap. When a stock's price falls hard enough, its yield can look attractive while the underlying business is actually deteriorating. Now, SCHD has the dividend growth screening rule built into its index, which protects against that. But it's not bulletproof. And number 4, SCHD's own yield, at 3.3%, is near historical highs for the fund, which means SCHD itself may already be reflecting a lot of the rotation. Translation: some of the easy money in this rotation may already have been made. So who is SCHD actually for in 2026 at these prices, with this Fed? If you're nearing retirement, looking for income and downside protection, SCHD makes more sense at these levels than it did a year ago. If you're 25, with 35 years of compounding ahead of you, VOO still likely wins long-term, and the 3-year and 5-year numbers I just showed you back that up. But if you're somewhere in the middle, and most people are, a dedicated allocation to SCHD inside a diversified portfolio makes a lot more sense in 2026 than it did in 2024. The fund that survived the crash is still holding its lead, and the macro backdrop favoring dividends hasn't changed. So here's the framework I'd actually use to think about this. Step 1. Don't chase the 5-month return. Chase the structural fit. Step 2. Know what job each fund is doing in your portfolio. VOO is your growth engine. SCHD is your income and survival engine. Step 3. Recognize that the macro picture has genuinely changed. This isn't just one good year for SCHD. This is a different regime. The real answer isn't SCHD versus S&P 500. It's both, in balance, sized to your situation. Here's what I would actually do if I were sitting where you are. Don't FOMO into SCHD at near record highs because of a viral chart, but don't ignore it either. Dollar cost average into SCHD over the next 6 to 12 months. Don't try to time it, then hold. If this helped you think more clearly about SCHD, hit subscribe. Next week, we're breaking down what the new Fed chair means for your portfolio in detail. Same time, same channel, no hype.